Okay, good morning and welcome to the Minervini Private Access Training Room. I'm Bob Weissman. If you can do a quick raising of your hand to let me know that you're hearing me loud and clear. Hope everybody had a good weekend, enjoyed some good football. My Eagles are not until tonight. And let's also welcome Mark Ritchie into the room. Good morning, Mark.
Morning, Bob. Morning, Mark.
And if you could just quick raise your hand to let us know you're hearing Mark clearly, that looks good. And also, let's get started then by handing this off to Mark Minervini. Good morning.
Okay, good morning. Hope everyone had a good weekend. Just real quick note on the market. Of course, we had some major distribution last week. Index is rolling over, stock positions hitting stops. I mean, it's obviously an ugly picture out there, and that means that you should be in very high levels of cash, if not 100% cash at this point. And of course, leading up to this, we were advocating small positions and high levels of cash. So you shouldn't be feeling a whole lot of pressure here. I'm putting ideas on focus lists that are holding up in bases, but again, I would use them more as reference points. And if you're actually taking any positions, very small pilot positions, just to keep your toe in the water and get a feel here. But I certainly want to see how the week transpires here into the middle of the week, and also how we close the week. And that's about it. You see some shorts being put on here. Dix, of course, is following through to the downside here. Wing still looks shortable here. As a matter of fact, this will rally back here. Yeah, I'd like to watch how it acts today, maybe how it closes. But if I didn't already own it, I already have a short position. I'll probably short some right here. And then, of course, a couple that we put on. Waste management, of course, this may rally back to the 200, but it's really starting to roll over here, along with this BBWI looking very heavy. So again, rallies would be shortable. And real quick, one last thing too, on Monolith, we added some new indicators, particularly in the gap area. We're working on some other ones too that will be programmed and up and running very soon. There'll be some nice relative strength, RPR, relative performance rank indicators. But the gap indicators are going to, and let me see if I can pull this up. Pull this here. You're not seeing the whole screen, but if you just look right here, so right here we had that big gap, and you can see if you look up in the right-hand corner, it says largest gap. So this will look for the largest, or the last, or I think it's the three largest. I can't remember. I'm the one who told them how to program it. I can't remember if I told them the two largest or the three largest. But I believe it's the three largest gaps in the last 6 months. And then you'll see there's a few different gap alerts. You can look for just gap alert, and also for the largest gaps. So this will be very good and useful. Number one, if we get sold off here, like this right here is a whole bunch of warning signs. You got largest down day, 3 lower lows, daily under pressure, close below the 50, 3 weekly lower lows, and a largest gap. I mean, that is like run for the hills. You see something like this happen, you own the stock, you sell it immediately. That will help with that. Also, on the upside, when you get a stock that's really getting extended and it's running up, you look for the widest spread, you look for the largest up day, extended, and it'll show when the stock's extended, it'll say extended, or very extended. And then if you see gaps there too, you put all that together, that's a great time to sell into strength when it's getting exacerbating itself too much to the upside and getting climactic. So both of those can be used on the upside and the downside. With that, let's go and get into questions and see what you guys are thinking here, and we'll do our best to give you some guidance.
Yeah, one question is asking just to have a quick review of the ants. Just paraphrasing from John, it's just referencing it's how many days out of 15 up, how many days out of 15 good closes, and how many days closing on its high where it needs to be.
Well, answer just days up versus days down. It's 12 out of 15 days up. That's all it is. And we've added, David Ryan and I put some qualifiers in there, and he likes to have 20% increase in volume over that period. So sort of an average volume being running higher than normal. And that's really, the main thing is you have those. Now, of course, it's better if you're in an uptrend than in a downtrend. And also the ants will have a different meaning if you're getting a breakaway. This is something that, matter of fact, I was just putting some slides together, or actually beefing up some slides for this year's Master Trader program in this particular topic, where when you get a breakaway from a base and you get into a new uptrend, ants are good. When you get 12 out of 15 days up, lots of days up versus days down is a good thing. When the stock gets extended, or it's on its late stage base, may say it's its fourth stage base, and now it's run up and it's 12 out of 15 days up and it's hyper extended and it has an accelerated rate of advance, that's now a bad thing. You want to sell into that. That's getting exhaustive. So you have to, again, everything has to be put into perspective. If it's early stage versus late stage, if it's an exhaustion move versus a breakaway move, and so that ants, indicator will help you determine that. But there is no, good closes, bad closes. You'd like to see a lot of good closes, more good closes than bad closes, more up days than down days, as well as a confirmer with the ants. But the ants itself is based on just the number of the days versus the down days.
And it doesn't need to have a percentage move as well, 20% move, Mark, or is
And
it
yes,
just
yes, and have and be up 20% over that period.
okay?
Those are the qualifiers. That were the 2020 qualifiers: 20% move and 20% volume running higher.
Okay, good. Roberto is asking, the THR trade took us out today. The question is whether it is valid to place stagger stops at the break-even minimum and then at 15 minimum and finally at the maximum stop to avoid taking the complete loss.
Well, well, we don't want to avoid taking losses. We just want to keep losses small and try to, of course, only um, only get aggressive when things are working. So with that batting average doesn't work against us when we're getting stopped out a lot. So I understand what you're saying. There's a lot of volatility here after the breakout, like we've seen on a lot of stocks. And so I want to be out of a name like this if it's not acting right. But as long as you're having the same stop, if you're going in there and you're saying, hey, I'm going to have an 8% stop here, but you want to use a 4 and a 12, well, you're still going to end up with the 8% stop. So I'm okay with that. That's the bottom. The bottom line is that the overall loss is still the same. You have to make a determination of how tight you want to be on the first half, for how much you want. It's room it's going to give you on the second half. So obviously, the tighter you are in the first half, if you went 2%, you can go 14% in the second half, right? I wouldn't do that, because that 2% would almost absolutely for surely stop you out. So I'm usually 4%, 6% on the first half, and then I'll stretch out the other half. But yeah, I mean, though, there's a couple. Mark, you'll probably give the same answer as me, but let me let you answer this. What are the circumstances that you would use a staggered stop versus using just a straight stop and say at 8% versus maybe a 4 and a 12, or some other combination?
Well, I think this is a good example. Let's say if you want to take a bigger position, and I talked about this a little bit on Thursday, and I think we even talked about this example, where I don't want to take the entire position down to 8%. Well, I have some options to make. So, but this particular situation where it was pretty tight, if you look at, on the breakout day, this was a good VCP. So if you really, in a good market, I might use, maybe a third of the position on the day before's low. If I really think the stock should just go, we had a little volume dry up there for 2 days. This is exactly what we've been seeing, where stocks just break out and then they reverse. But, I would stagger it where you maybe sell a little bit below the low of 919. That's actually exactly what I did. I took a tiny position in this, and then, maybe 913, and then the rest at the low of 98, or you still get the blend of, 4 or 5%. But, if you have a much larger position, that's how I would handle it.
Yeah. So the scenario that Mark's talking about is about a 2.5%, 3% stop on the first one and a 5 or 6 on the second one. So now you take that, you blend that together. Let's call it 9 or 10%, and now you've got a 5% stop overall, and you're being real tight on that first part. Now, a few things. One thing I like to do is, if I'm going to use something like this, for instance, okay, I get out real quick, it doesn't work on half of it. Now, if it's real tight at say 2, and I want to have a no bigger than 8% total loss, well, then I can put a 12. That's a long way down. I'm probably going to know before that, before it hits that stop, it's going to, but it's giving me another look, right? It's giving me that patience. So now I get stopped out on the first half, and now I can watch, and I've got that second half as a backstop, as a safety measure to keep me at that maximum stop. But now I'm running monalert. I'm looking and I'm seeing, hey, are the violations piling up? And it might be below the 50, below the 20. You're coming back in on heavy volume. You got 3 lower lows. Hey, there's 5 violations here, and I got stopped on the first half. I'm down 5% here, 2% on the first half. I'm not going to wait till it goes down 12 or 14%. Why would I give that back when there's so many signs? But now, if you really in a stock that you say, you know what, I really want to hold this. I don't want to get shaken out of this thing. So beginning of a new bull market. This company's doing great. I love this. I love this setup. Love this company. And you just really want to be in it. That's where you give it that extra room. That's what I'm like. I'm never giving it the extra room because I don't. And this is where I want to go back to the question. The question was, to avoid being stopped. That is not what I'm trying to do. As a matter of fact, I want to be stopped out immediately. If I'm going to be stopped out on half my position, so I never get upset getting stopped out. Being stopped out is just part of the game. So I'm agnostic when it comes to stops. If there's lots of stops, then I know the market's not that good, and I pare back my activity. But the average trader is upset. They're getting stopped and they're upset over it. What is that?
I think that might have been me adjusting my mic. Sorry.
Okay. So that's where we got to get the emotion out of it. What I'm using a stagger stop is if I'm in a volatile period. All right. And I think the volatility is going to take me out of something that normally, I should be able to hold through, or it's a company that I really want to keep my position in. Those are the only times I'm really going to use that, is to try to get through the volatility and still have a position and hang on to something that I just don't want to get shaken out of, but not because I'm trying to avoid a loss.
Okay. Eric noticed the distribution day 3 weeks ago. So when Mark confirmed it during the weekend videos a couple of weeks ago, I was glad that it was a sort of proof that he's learned something, except I didn't know what else to do with that information apart from being even more cautious. Is that all a trader can do with a distribution day?
Well, with when you see the distribution days in the indexes, this doesn't mean you just start punting your stocks. You just pay some really close attention and start to maybe, if you start seeing a lot of distribution in the market, you're probably going to see some stocks starting to act funny. Maybe not though. Maybe not. If your portfolio is holding up beautifully and you've got distribution, well, then I'm gonna hang in there. But now, if I start getting hit on a few and it all starts to culminate where not only am I getting distribution, but my portfolio is not acting very well, then I start tightening up. Mark, how do you handle that? You're getting distribution, but you don't yet have your stocks moving in on you. Maybe you've got some, fairly decent gains. You got a couple that are borderline. Are you hitting the bid and running quick? Are you, what is that distribution day or a few days of distribution? What's that going to do to you as far as your tactics are concerned?
Yeah, I just kind of see it as that first shot across the bow. It doesn't necessarily, there are times you have a distribution day and your stocks hold up great. Well, especially if you're in some leaders. So yeah, to your point, it's always default to the stocks, but I've tended to notice it's the distribution day, sort of like we've had where the breadth has been poor as well. And you highlighted in the weekend video, that seems to be the cocktail that, where normally you wind up getting stopped out of whatever you have anyway. And then I would just temper, if I don't have a lot of buy ideas, I would be even looking more at the lists rather than watching the indexes. Again, going over your list, going, what are the bulk of the stocks in my universe doing? And are they holding up well? Because we get one-off distribution days all the time. That's the other thing. If you look lately, and Mark's been pointing this out, we've had clusters of them. So within a day or two, you get another one, you get another one. So yeah, it's more just looking for that character.
Yeah, I'm looking to see if we're distribution dominant or accumulation dominant, which means that we're seeing, almost like you're looking at the up days versus down days, the good closes versus the bad closes. What is the weight of evidence? And that's what you really want to get good at deciphering. So a couple distribution days, but now maybe you get an accumulation day and then right away it fails and a couple stocks start coming in on you. Well, right there, that's okay. You know what? That's like Mark said, that's a shot across the bow. All right, let's watch carefully here. Maybe we pull back a few of them that aren't acting right. They're closer to stopping us out. We'll take a few off the table, hang on to the better acting stocks. The stocks that are extended, that's another area where you start getting distribution. You've got a handful of names that you've got nice big profits on. They start coming in on you. You don't want to give that back. So that would be a good time to start taking some profits. Not going to hurt you to take some chips off the table. Maybe you sell half your positions on some of the big profits, and now you bank a little. So it's always incremental. It's very seldom you're going to just make this big giant shift unless there's really something very, very violent that happens across the board, very quickly. And it almost never happens that way. It's always to a somewhat of a gradual move.
Travis is asking if you can look at FLR
Floor. Yep.
and
Oh,
grade his
that's not right.
purchase of 918.
918, which is obviously right here. Yeah. I mean, I had floor on my watch list. It wasn't brought all the way up to my focus list, but it had a pretty big base here. Had the big gap right here, and then trying to tighten up. I just don't think it was tight enough. And in these cyclical type names, you get these short term moves out of them. They've been very tough to get any kind of real long term move out of them. So I think it was premature. I wouldn't have bought here until it tightened up a bit more. And even then, you gotta, have a really strong uptrend. Again, it's a good base. It's definitely a good size base. So, but a good part of the base is below the 200. So this is the kind of base that I would buy out of a bear market if the whole market was sort of looking like this and you had lots and lots of bases that look like this. And there really wasn't much other than, the better stocks, the best stocks look like this. Let's put it that way. And then you would probably see, higher relative strength rankings here on these type of names. But in this market where we are, I would probably wait to see this to be a bit more developed on the right side.
Okay. Omer is asking if you think it's smarter to use the RS versus the NASDAQ instead of the S&P 500, since just a few big cap names are weighing so much on the S&P 500. The NASDAQ seems to be a more representation of the market as a broader measure.
No, I disagree. I think the S&P is the best representation, even though it's 500 stocks. The NASDAQ is highly weighted too. So, so you're going to be about the same as far as like the true picture. But the S&P 500 is really been the rock solid sort of canary in the coal mine, if you will, or at least representation of the market over the years. So yeah, I think either one, you're going to see a very similar picture too. I mean, sometimes you'll see some variance, but it's not going to be too far off of each other. We actually consider doing a blend and doing a total market, which I may do. We're probably going to ultimately have several relative strength lines for you in charting, and that will have you'll be able to put the NASDAQ, the S&P, or do a blend, and actually even decide what the blend is: 20% S&P, 30% this one, 40% that one, and blend them. So that's on my list of things to do. It's just not high on the list just yet, but those are. So we're going to keep adding indicators that are very, very progressive. There's stuff that we're doing already that you see that nobody else is doing, and we've got some other stuff that's real interesting too.
Yep. Augustin is asking, Mark, despite being a low price stock, AVPT.
Yeah, AVPT. Yep. Look at that.
Bought it on August 15th.
August 15th, which is over here. Yeah, again, this is where like I would have probably waited, for it to be a little more developed, maybe a little bit tighter. Came out a little premature, but sometimes they do that. And you saw that's why it came back in here because it had a little bit of supply left, came back. And then right here, this is probably where, if I were to buy the stock, it would have been on either 829 or 830. So you got that tight little pivot right there. You went through a nice little pullback shakeout. See how this is like a little mini, it's like a little mini cup with handle, little mini cheat area or a little mini VCP. That's what we call fractals. We have patterns inside of patterns, and that's a really great it's a great sign. It strengthens the pattern when you go through these iterations because it allows the stock to change hands and go through a natural distribution and accumulation process. Now, this is not acting too poorly considering it broke out. It came out off the cheat area here, then right here, and now it's drifted back here. You caught some support here as it undercut that low. It's really acting pretty good. If it could stay tight and then turn up here in a good market, I'd actually add to my position. If I was buying it here where you bought it, or I was buying it here where I think I'd be buying it, I'd probably add to the position turning up from here. So it looks good. I mean, it looks really good. It's very low price, so I generally stay away from that. But the chart looks pretty damn good.
Yep. Anders is asking on CRS.
Yep.
June 28th. June 28th is when he bought that and sold it on July 27th after the earnings release, and or half on that day, and is free rolling the rest using a 50-day trailing stop.
So bought it here on June 28th, coming out of a pretty nice, well-formed. You got a nice VCP here. It went through a couple corrections, tightened up on the right side. So that's really just classic coupled handle type action. Bought it here. I guess you went through this pullback. When was the sale?
July 27th.
July 27th, trimmed, right?
Yeah, with the earnings release.
Yeah, I like the way you went through this pullback. So you stayed patient through the pullback. That was excellent. This is the type of thing where a lot of people will sell out right here, and they'll panic out. The stock will run up, and then they'll sell it as it comes back in. They don't take the quick profit, but then they take the quick loss or the quick break even. It's not doing anything wrong yet. You run Monalert here. It's not going to say anything wrong at this point. So, and then you see a couple days later, you get the tennis ball action. So that's great. I'm sorry I have to ask again, but what was the date of sale?
Right there on the earnings release on the 27th.
27th of July. Yeah, so that's over here.
Right.
Yeah. So then, okay, so the little bit here as it came out, I mean, really wasn't doing anything wrong. Didn't really give you like a big bump on the earnings. So like I usually sell in the earnings when you get a gap and it runs up. But it's fine. You nailed some profits down. Now holding the rest of it still?
For with the 50-day trail.
Yeah. So now as you get far away from the 50, you got to be mindful that, if this would run up and get real far from the 50, yeah, that'll keep you in. But you also got to look at, and Mark, I'm curious to hear your feelings on this and how you handle this. If you're using a 50-day trail and then you get climactic, you get far away from the 50. So now to get to the 50, you might have to give up 20, 30%. See, I'm not willing to do that. So what I do is when you go climactic, I start tightening up either with a backstop or I start using tighter moving averages. I might use the 20 or the 10, whatever moving average it's held for a long period of time. So let's just say it's held a 10 day, through this entire move, or even in the accelerated move, it's held the 10 day. And now it gets way away from the 50. I'll switch over to the 10 day. See, because it depends on your goal. If your goal is to hold it for a big giant move, yeah, then you might have to give it that downside and go through that, because it's the only way to get to that bigger move. But my goal is to nail down a decent profit. And if I get a really good profit and it gets where I've got to give back a lot of it, my goal is to nail down decent profits and to never give back a lot of money that I've made. Like I'm never going to give back 30%. Ever. It doesn't matter. I'm never going to do it no matter what the circumstances. It's just too much. It's just I work too hard to get it. It's too big of a gain for me to give back. Dollar wise for me, usually that's a lot of money. But everybody has their own thresholds. Mark, how do you handle that?
Well, I was just going to add, one thing he could consider adding to the 50-day trail is that extended recipe in Monalert. And I just ran it. And if you look, because really what you want is you want that Monolert's second set of eyes tracking when it gets extended versus its own price history. And this picked that up in terms of it got extended versus the 1 year history. And then you had a reversal. I think it was September 14th. It caught it right there. So that would be a day where I would at least be potentially leaking out some more shares or just reducing the amount of overall pullback you're going to have. Because yeah, eventually, to Mark's point, if you just wait till the 50 takes you out, that's fine. It'll keep you in, but the give back is going to be painful. So the way I would buffet that is by when you get hyper extended versus its 1 year history, you either take all your profits or leak some shares out and trade around the position that way.
When you want to look, when you're selling to strength, just again, if the stock's like running way up and really accelerating, what likely will happen is even if you sell it early and it goes up a little bit more, it will probably come back in, move sideways, and give you an opportunity to buy it lower and just get back in and actually make up for for some lost time. But the bottom line is that, like Monolith, for instance, like I look at these stocks and I basically see these things, but Monolith does even a better job than me. Monolith is designed around Mark Minervini's eyes. It's what I look for, and it's looking at the stocks just like I would look at the stocks. The thing is that I have to calculate this stuff by hand. Like I'll go back and I'll say, okay, let me see, this looks extended. And I'll go back and start calculating its history. And the Monolith does it for you in 1 second. So I even use Monolith now. I run it and I see if it says it's extended. Then I go and I investigate. And so at that point, you don't have to just sell just because Monolith says it's extended. It might get even more extended. But now if you go extended from there, you really should be selling into the strength. So it just gets more and more more and more ominous at that point.
All right. And the only other follow-up question he had is, would it influence your decision to hold longer as the stock is in
What was the symbol there?
CRS?
That's what I think. CRS. I just want to see something. So we're going to run here real quick because we got this partially on the screen. Let's run extended. Yeah, so you can see right here. Yeah, extended 1 year history. See that? So it's telling you right here, extended again, and you got a reversal. So right there with that reversal and extended, if I had a big profit, I'd probably take some off the table right there. Let's see, reversal. You got now you got another reversal here on Friday. So right here, and here, right at that price, you're getting reversals off of an extended condition. So that's just what Mark's talking about. You see, it's going to pick it up. And what it's doing is it's looking at its own history in the last year. Like some stocks that it'll be extended will not be extended versus their own someone else's history, another stock. This is based on the stock's history, and that's what's really unique about this. Well, go ahead.
So the follow-up question was if it would influence your decision of holding longer as this being in the steel industry in a deep cyclical sector.
Well, I would hold less. A cyclical, I would hold less time, and I would be more apt to sell it into strength because cyclicals are cyclical. They're not growth. They're not able to go through multiple cycles and to keep churning along like a growth stock. So it would be more likely that I would sell into strength, a cyclical.
All right. Matt is asking on GKOS.
Yep.
He bought on August 29th.
Yeah, right here. That's a good buy.
If the stock can get through the reversal of September 12th, he might add to the position. How would you grade his
still
plan?
in it. So you got through this pullback. That's impressive that you're able to hold through this pullback right here. Once again, you see what I was talking about before? It comes out a couple days down, shake out. It didn't shake out the low, but it came down. You get a good close, and then boom, you're right back off to the races here. Just a few days later, you're back. You get the tennis ball action. So that means you can stick with it. This market, it's hugging the 50. I don't like this hugging the 50. This hugging the 50 action is a sign of weakness. I just want to let you know. So that's the only thing that's sort of a little tip. Doesn't mean it can't work, but the more it hugs the 50 like this, the weaker it is. I'm sorry, I forgot the question.
Well, and I'll have to ask Matt to chime in because Matt, you're not telling us where your stops were when you bought it. You're sharing that you had a half stop at the low of the day you bought it. in which case, as Mark just pointed out, you would have been knocked out on
Would have been
September
knocked out of
5th.
half.
And then you're using the low of September 5th on the other half. Where was your stop when you bought it, though? Because you shouldn't be
Low of
in this
September
position
5th.
still. But nonetheless, he was asking if the stock can get through the reversal of September 12th, would you look to, he may add to the position. He's questioning.
I would not add based on it getting through the September 12th, because I'd have to see what kind of pivot it sets up. I mean, I would like to see it tighten up, right? I'll show you. And again, if it holds up at the market, if it could tighten up here maybe a little bit, and we get tight, and then it comes out and takes out these reversals right here, I'd be buying it. I'd be adding, or I'm sorry about that. I'm buying it or adding to it. If I didn't own it, I'd be buying it. If I did, I would be adding. I would be adding to it as it gets through right there. See, that's the majority of the action. I'm not going to key in on this right here when it gets through the majority of these reversals. Even if you take this all the way over here, take a look right here, right? So the majority of the action is right around this price level right here. You only have where it's only closed above that level on 1, 2, 3 days, way back here. And you see a reversal here, reversal here, reversal here, reversal here, reversal here. So as it clears that, that's where I'd be going. So you want to see it tighten up on what Livermore referred to as the line of least resistance, and that's right here.
And apparently his original stop was 71.40, so that's what kept them in that shakeout day of September 5th. And now he has raised the stop again up to half at 73.
Right. So you had it below here. You had it right below here.
Yep.
You knocked out a half. I think it's played perfectly. It's perfectly, and I love your reset of using this low, which is really not any different than this low. Really, it's pretty much the same. But this is key now. Now that you shook out down in the low and you've recovered back all the way up here, yeah, this definitely should not come down and take out this low. So yeah, it's perfect. You're playing it perfect.
Keshav is asking, as a situation where he lives in India, is that the high RS names usually have small bases. To look for larger bases, you have to consider a lower RS. What should be preferred, a higher RS or a bigger base? Obviously, both would be best.
Well, I would be willing to bet, but I could be wrong because I don't know for sure. But I would be willing to bet that that's based on a limited amount of data, and maybe your experience in maybe the last cycle or a shorter period of time. I think if you ran and looked at a study over the long term, I'm not sure that would be necessarily true. So, but with that said, I don't know what you're referring to as a short base either. That's a relative term. Short for you, maybe you're saying it's 2 weeks, 3 weeks. I don't know. But again, the high RS, you're going to want to go with the higher RS names and buy them coming out of bases. You're still going to want to have basically the same criteria. I mean, again, I don't have enough information from you to really know how to answer the question.
VSE Kelly is asking, seems to have a large VCP base forming, but thinly traded. Can Mark comment on the percentage?
Victor Sam Edward?
Right.
No, I'm not getting anything. So that's probably.
Yeah, me neither. So VSE Kelly, maybe need a better. Can you retype the ticker symbol?
Some really small name that's not covered. I don't know.
Or maybe not in the US. I'm not sure.
Yeah.
While you're doing that, let's move on to Constantine is asking a question about scaling. How would both Marks, if you could review the open position wing, please, since you talked about scaling into that a couple of different building a position.
Wing, yeah. Okay, let's take a look at wing. Shorting is a much more difficult task, and I'd be really careful and keep it a small part of your repertoire. There's gap risks, it's unlimited upside. But just looking at this, I mean, as it breaks down here, one way is, of course, you can short it as it starts to break down. Now, again, if you're going to have it come all the way back, coming back to the 200-day, when it first breaks below the 200-day, happens very often. Sometimes they just roll, and then sometimes they come all the way back. So again, the way I usually play it is I'll play it on the breakdown, and then if it comes back, I'll keep the stop relatively tight. If I get stopped out, then I look to fade the rally back to the 50 and the 200. And then here you come back to the 50, maybe you start a position there. If it starts rolling over, you add to it. If not, and it moves up by the 200, I'll see how it acts at the 200. If you can get above it, you get the reversal. This was just classic, the way it reversed above the 200. And it was, I think this was around the news, like bullshit news, like Kramer or whatever. So this is a perfect opportunity, to get back on in short or add. And now even here, I mean, if you can really start to roll over here, I'd probably even add to it even more.
Do you consider LYTS buyable today above 1565?
Yeah, so this is one I saw this on the weekend work. There's this big base form with this nice gap, and I like it. It's actually on the on deck names. It's buyable above the 1563. That's the little pivot right here. But lower price name. I'm going to hold off right now, but I think it's a good eye, and I love the big move here, the pull back here, the drifting back here. Yeah, I love this little tight. You see this little tight VCP, and then you get the failure, and then you undercut the lows, and then you form a new one. This is sort of like a little mini failure reset within the the potential handle here. So it's acting pretty good. I wouldn't be surprised though if it still has to stall out here and tighten up even more. And this little bit of supply becomes formidable because of the market environment.
Okay, that stock was VSEC.
Okay, let's go back to that. VSEC. Vasectomy. So I'll remember this one. All right.
And Mark comment on the percentage of the time in his 40-year career where he gets easy dollar environment. This is a follow-up question. But first, your thoughts on VSEC seems to have a large VCP base forming.
See something. Okay, so what I'm going to do here is I'm going to go VESC. Right. Whoops. Did I get that wrong? VSEC?
Right.
Yeah, VSEC. Yeah, I just want to look. All right, so over here, this right here, I want to look at that. So this is widest spread, dollar spread. Okay, it doesn't say it's the biggest break, which I'm surprised that this looks like it's the largest down day. I'm not sure why it would. Which is not saying it's the largest down day. Looks pretty large to me. I'm a little concerned about this big break here. And it comes ripping back over here. So that's the largest gap up, right? Gets extended in the short term, widest spread. So we went widest spread on the downside, widest spread on the upside, big volatility here. So what I like is that it's tightened up really nicely. And if it breaks out of here, you're clearing out these highs and you're clearing out the supply. Relative strength has come back quite nicely. RPR ranking 91. So it again, I don't know much about this one, but let me see. I'll bring it up on MarketSmith now. You're just looking at a few things here. Yeah, and again, let me get the exact question. What is the exact question?
Well, on the VSEC, just asking your thoughts.
Oh yeah. Yeah, not my favorite, not my favorite. But it is a nice big sideways basing action. It looks laggardish, Now it's starting to outperform a little because it's holding up in the market, but it looks like a laggard. It's not very strong. And you got this big break at this big volatility, but I would say, it's probably tradable.
Also a little spreadier.
Yeah.
Yeah, he did mention being very thin.
In a really great market, right here in the little pullback buy, I'd be buying it right here today. This is where I would start a position. And then if it can move up and take out these highs, I'd add to it. That's how I would play it if I was interested in it and the market was acting well.
And then the follow-up question was, in your 40-year career, what percentage of the time would you consider the markets to be easy dollars?
I mean, I don't know. I mean, it depends. Some years it's easy dollar for half the year. There's years you don't have easy dollar for a whole year. It's usually get some type of easy dollar environment, every year, except in like secular bear markets, they're short lived. It depends. I would say, maybe. I mean, this is just a pure guess. 25% of the time, 20% of the time, 30% of the time. I don't know, Mark, what do you think? How often do we have easy dollar, over the long term?
Yeah, I was actually going to say maybe 25% it's really really good. 25% you're just waiting, and then the rest of the time you're jockeying for position. But again, those are just armchair
Yeah.
numbers. I've never done any hard calculations on it.
I would say definitely half the time is just like waiting and jockeying, and then, less than half the time is it really good. Really, really great periods are definitely shorter, and far and fewer between. But again, that's where you make up ground so quickly that I've had years, where I've made giant returns in just a month or two. Returns that people would love to have for a 5-year return, I made in 1 quarter. So when it is good, that's where it's it's feast time. I think the real key is to just to keep your powder dry, and all the rest of the time you're gathering information, and it's all setting up for that time. Now that comment that William O'Neill made, I think he wrote it in his book, but he actually told it to me personally, and it was one of the most important things ever said to me was about trading, was that while you're doing nothing, the lesser skilled, the people who don't know what they're doing, the people that are not disciplined are forming the basis for your success. They're forming the cup with the handle. They're forming the VCP. They're even the mutual funds that are in there and buying the stocks that are down and supporting them around the lows. They're all forming you're all forming the basis for your success. They're creating that opportunity. So, and with that in mind, I looked at being out of the market as a real necessary part of the process, and just waiting with bated breath for that opportunity. And it really appealed to me that I could make a lot of money in a very short period of time. And most of the time I could be in the safety of cash, because I always looked at the market as extremely risky and I didn't want the volatility. So for me to be out of the market, I love being out of the market. Like most people, they want to be a trader. They want the big screens wrapped around their head. They want to be in the cockpit and be Gordon Gekko. I wanted to be a trader, but I also wanted to get rich from doing it, and I wanted success, and I wanted the big returns and the low risk. And I didn't care if I got the big returns in 1 month out of the year and I had to sit in cash for 11 months. I actually would prefer that. So less work too, So that's what appealed to me.
All right. Actually, I had a follow-up question on the same question from Jerry as well. So I think one thing to share with you and also Constantine is or Kelly rather, is the easy dollars do tend to come in more of an uptrending market. And of course, we went through a full-fledged bear market last year. So I know the last year has been seemingly forever long without having an easy dollar environment, but
Right.
we're in the new
in a bear market.
we're in the new throngs of a new bull market upon us here, and so it's something that I think are going to be seen sooner than later at this part of the cycle.
Mm-hmm.
Muhib is asking, let me look at that first because it's a little bit long. Jerry asking, Mark, I always appreciate your weekend study sessions. I used to spend countless hours trying to interpret the stock market and all the various moving parts. Is this a skill I can learn over time?
Is what a skill you can learn over time?
How to interpret the stock market and all the various moving parts.
Of course you could. Anybody can. That's the whole. If that wasn't the case, I wouldn't have. I would shut down this service tomorrow. So because that's the whole mission, is to teach people and to help them to be able to do this. So anybody with a working brain, you don't even have to be highly intelligent. Just very, very normal intelligence and a good work ethic and a realistic time frame that you're going to give yourself enough time to learn this. People get into this, and then in a year down the road, if they're not successful, they give up or they change the strategy. And you just got to realize that Even if you were to go and learn how to be an assistant manager at a McDonald's, it would take a while. You have to learn the procedures, and so this is something that's much more difficult than most jobs. We've seen everybody from surgeons to lawyers to PhDs fail at this because and sometimes the smarter they are, the quicker and the harder they fail, because they think they should have success quicker, or they have such a big ego or such intelligence that they dig in with opinions and they can't let the market dictate. So sometimes having just average intelligence is a blessing. But yeah, anybody can do this.
John is asking the question to Mark Ritchie. What is your plan for the add-on buy for TDW? Are you managing it as a separate trade compared to the 50-day trail on the other buy?
TDW?
Correct. Thomas.
Yep. Yeah, it was just because he's referring to adding to the position on 830 and 831. So I was holding a small position using the backstop big move after it triggered the Ansett monolith back in the summer. Added some, reduced it when it got extended, sort of just trading around the position. So I added a few shares back on 830, 831 and sold them, I think, on 911. I can double check that with Brandon, but same way I would do it with any position. And then back to the smaller position I was holding. If it closes below the 50 or we get a cluster of violations on the backstop big move, we'll sell the remainder.
And just to let everybody know, I don't know where you are, Mark, for the year. I'm up single digits now. I am up for the year, but I'm only up I think mid to high single digits right now, 6 or 8% for the year. So I've made really no progress this year myself.
Right around flat myself. So just treading water.
Yeah. So if Mark Ritchie, who's had a 13-year track record of, beating the S&P by 20 times, and with only 3 down years, that being down 5, and 6%, and Mark Minervini, who, isn't doing well in this market, don't get down on yourself if you're having a tough time lately. But it'll come, and we'll knock it out of the park. If it's not this year, it's next year, and we'll make up for whatever lost time. The main thing is, you won't see Mark or I, get down big. We'll never let the market get its teeth into us. We're always, working with capital that we've made in the market and progress. And it may take some time, and we may jockey a lot and tread water a lot, but eventually, the pitch comes across the plate. And when we hit it and we start getting those base hits, and then we start getting some doubles and triples. When I say doubles and triples, I don't mean actually doubles and triples, just bigger gains for us. For me, a double and a triple is like 30, 40, 50% gain. We'll be compounding on capital, not digging out of a hole, and that's the key. That's the real key.
All right. Question on LPG.
Yeah. Natural gas.
Purchased it on September 21st entry. If you can evaluate.
This is yeah, let's see. What's the purchase?
September 21st.
Yeah, right. Yeah, right here. Well, I mean, you probably moved in just a little bit early. I would probably wait until the 22nd, until it actually broke out. I would like to see it tighten up maybe another couple of days, but it's fine. Looks fine. Energy areas. Let's see. I just want to bring this up. LPG. Let's bring it up on a Market Smith chart. Yeah, oil and gas, of course. Yeah, 98. I mean, obviously, some of the energy is acting better here. You got oil prices moving up, but this cyclical area has been tough. So I just trade it. I just trade this area. I'm avoiding it, but if I were to go in, I'm just looking at it as trading opportunities.
And also, Mahib is referencing using Monalert going back into May period, particularly there on the 23rd, that big breakdown day.
For this stock?
Yeah, right there on May 23rd.
LPG. Hold on, let's bring up Monalert here. So I know you only have part of the chart here, but it's better than none. Where are we going?
So if you set your look forward from May 19th.
So May 19th.
Right.
Right here.
Look forward from there.
Yep.
And then the 3 days later, that big down day, it's not showing up as a violation or
No,
And
why would it? Is that a question or is that a comment?
it was a question. Didn't pick up any violation.
No, it's not a violation. Well, what violation is there? It's not below any moving averages. It's down 2 days out of 4. Um,
Right. So that's 50
where's the
percent.
what violation do you have? Yeah.
So there you go, Muhib. Nothing wrong with the result. It's just
All you did
there's
is
no
just pull
violations.
back to the breakout and you had a mid close. I mean, it wasn't even a bad close. So there's just no violation there.
Or maybe the day before, close on the low there.
Okay, so you got to close on the low. Not sure why that's not showing close on the low. That's a good question. Actually, because you see, it's not on the low. It has to be within 90% of the range, I believe, and that's
Yeah.
probably it's probably like 89. You know,
Yeah.
yeah,
If you do
not
the
close
closer
enough to
look.
the low. Yeah, not close enough to the low.
Okay, good.
Yeah.
Also was asking if you could look at SPHR.
Hold on, just checking something here. Although that's saying not. Oh, I'm sorry. That's because I'm an extended. Sorry about that. I forgot. I got the wrong recipe. Let's go to a recipe. So this will probably right here. Let's see. That's close on low. I'm off the chart here, but over here you see close on low, and then right here you don't have close on low. You actually have relative strength new high. So again, let's look right here. So I'm sorry, I didn't have the right recipe up. We were looking at the extended, but still no violation. See, there's no violation. Matter of fact, the day before you had a RS new high. You had 4 higher highs the day before that with an RS new high. 3 higher highs the day before that. The daily pressure actually just came off just a couple days earlier, obviously right over here. So yeah, this pullback is there's nothing ominous about that.
All right. Thank you for reviewing that.
It's a good little tip though, because I do it all the time. I start looking and I'm going, what the heck's going on here? And I'm in Ant's recipe, and I'm not seeing anything. So you got to remember that if you want to see everything, you go to all indicators. If you want to, see significance, I have my own recipes here. You can make your own, of course. But backstop is only going to show the extended. It's going to show close below 50 and 3 lower lows. So and the big declines. So again, make sure you're in the right recipe.
All right. And then on SPHR, asking if this would qualify for a low cheat and a pullback buy today.
Okay, so I'm gonna just looking at it here I want to go over back to here, SPHR.
Right.
Let's look over here too. It's definitely a low cheat. I don't have it into context here, but it's in an uptrend, starting to turn into uptrend. So this is definitely a low cheat setting up here, but this is basically a low cheat from a pullback within the low cheat. So you're just starting to, so you didn't complete the low cheat. To complete the low cheat, you would have to tighten up here and then take out this high, and this would make what we call the turn. Now that's officially in a new uptrend. And if you want, I mean, you could make a case for this right here being, this is what we call a bottom fishing low cheat. So you could make a case right here when it came through here, that's where it got into that new uptrend. And that's that earliest sort of early turn off the lows. But I like to see it mark itself up and take place in the middle third. In the lower third, you're getting into those really low cheats. This is more of a cheat setting up in the middle third.
All right. And finally, if ARES qualifies as a cap pattern.
ARES.
Yep.
As a cap pattern. No, I mean, again, we're talking a little bit of semantics here. I see what you're looking at. This is the base, and then this is sitting on top of it. I mean, you could call it that. It's certainly any little base, little pullback base of 9, 10, 12 to 18 to 21 days, somewhere in that range. They're usually between 12 and 21 days or 12 and 18 days for it to be a cap. And what I call a cap is when it forms a little mini pattern. So, I mean, you could just pull back here, and then I would call it a pullback to the breakout. Cap is sort of a little mini, goes through a little mini iteration, and you'll see like a little mini cheat area. So this is just a pullback to the breakout, and you could even maybe look at it as a high handle here as part of this base. I would still look at this because it's not too far out from the base here, the breakouts here to here, 3 or 4% pulling back. I would look at this as the handle in this big pattern here and this part of the tightening, and it's holding up with the market getting under pressure here. So this actually looks pretty good right here.
All right. Reading James is asking, is the buy on wing or the buy to cover on wing a mathematical stop, or is it based on the chart action
Which one?
for
I
wing?
mean, oh, you mean the one that we have currently?
Yep. And that's at 187.20, which is a 7.8% stop.
Yeah, it's really trying to give it the most room possible. That's really what it is, because the shorts it can run in the shorts and run this thing up. But to be honest with you, the more this runs up here, unless it really runs up a lot here, and then I would look for it, just to pull back, and it would be forming a new base here. But if this runs up much above this 200-day, it's becoming even more shortable to a certain extent, especially if the 200-day was in a downtrend. You see, this 50-day is in a pretty sharp downtrend. So if we were to run up here, right? Oops, let me just get this for you. If we were to run up here, maybe not in this one day, but we would run up here. Well, now you've got the 50-day moving down, and you've got the trend moving up here. That gives you that angle warning in reverse, of course, to the downside. So you've got, and if the 200-day was rolling over, then you're most likely going to come back down. Then the steeper this 50-day, and the more you're running back up above the 200-day, it becomes a pretty good risk reward to short it there. So I want to give it some room to do that. If it's really weak though, it should not go up much from here. I mean, this should be pretty much it. Maybe another day you come back and you fill a little bit of this range above the 200, and it should run right into selling. And so strength from here would definitely be, maybe shortable if it gets a big reversal, but trying to give it as much room as possible. That's the answer. So it's a mathematical stop. Technically, yes, it would definitely, getting above this high here, we don't want to see that. But like I said, now that it's broken down like this, if I didn't own it, I'd probably be looking to even short it there on a reversal.
Antium is asking if you could please share and go through recent examples of how you initiated larger positions in an effort to short-term trade out of a position to finance the stop and free roll the rest. And
I don't think I've taken very many large positions recently, so I don't really have many examples. Maybe relative to the position that I ended up with, I might take. So let's just say I buy 5,000 shares and it runs up, and I sell off, 3 or 4, and I keep a couple thousand or 1,000 shares to finance the risk. Yes, I don't off the top of my head remember. I can't really say. So I'm sorry, but I don't remember what I've done that with recently. But I haven't taken really big positions. Mark, I assume you haven't been taking any big positions either, right?
Yeah, I'm racking my brain to come up with a good example as well, but there just we haven't had the market to do that, so there isn't one recent that comes to mind.
Exactly, but I know what your question is that to finance the risk, taking a bigger position, then selling, trimming out of it. Just anything that's really broken. Let me just see here. What's recently broken out and moved up? I'm just trying to look here. TPX was a 7.7, of course. That was back here. Yeah, you have to go back to something like this here, where TPX comes out here, runs up here, and that's the type of situation. You take some off into this run up, and then that allows you to go through the the rebasing or a pullback, and you finance the stop. But I know there were a couple trades that I made, if you remember, where I talked about. I actually put in my notes that I was financing the stop, selling to finance the stop. So you might want to search the archive for that. I just can't remember what names they were.
Yeah. PAY. Gary bought it today.
Yeah. I mean, it's acting really well, in a weak market. So it's definitely showing some really good, relative performance here. I'm just going to stay away right now and not really buy anything. I don't think I'm going to buy anything at this point. There's just not enough setups. I don't know, Mark. Are you willing? Are you going to take anything? Are you completely waiting, or are you're open to grabbing maybe some smaller positions?
Well, I want to see at least some sign of stability somewhere, because the distribution dominant tape, it just feels like there's been no accumulation anywhere. You know, a name like this though is, if you, especially if it's smaller, I think it's traded 15,000 shares today, going back to the PAY. This is one I've been watching as well. But these are the type of situations where, like, a THR is another one. You know, I take a small position. That's a name actually you could have financed that name. In my, if you had a small, certainly if you had a smaller account, because it was really tight before it came out. So, and you got 4 or 5% on that first day.
Oh, right. The THR.
Yeah, the THR example.
Oops.
But yeah, right now it just.
Yeah, you're saying as this came out, you got on that first day, you got up enough to take a little off, and that'll cushion your stop.
Absolutely. Yeah.
Yeah. That's the type of situation. I mean, where I didn't buy THR, so I wasn't in this, but this is a very, if I were to buy this, maybe coming out of the pullback, buying around 27.80, maybe. Now it comes out about there, runs up, and now you're up 5% intraday. Yeah, that's a pretty good intraday move where, if you're up 5%, and you take that off, you can now cushion yourself a 5% stop, and you're breaking even. So that's a good example.
Question on Dom is asking about VMW, which is in a long-term buyout from Avago.
Yeah.
Broadcom, buying it at I want to say 80 a share, I believe is what the offer was in cash. So it is setting up though nicely. It's on our focus list, of course, but with that limited upside, purchase a portion on 920 at 168 and would look to add to the position if it breaks above 169. Dom's asking if you can evaluate his plan.
I think it's a good plan. I mean, we were just talking about it this morning as far as whether we should put it on or not, because it's this takeover. When you get proposed mergers and things like that, we usually stay away from it. But it was so far back, and like you said, you have this this upside, although limited. The stock's acting really well, so I wouldn't buy it here though. I'd want to see it tighten up. You got a little shakeout here, and then I'd want to see some tightening, and then maybe hold up, in a weak market, and then come out from there. This is when you get the type of action that we had last week. I generally like to see trading into the midweek and see how we close at the end of the week, because a lot of times what will happen is you get some of these names, they'll snap back off the lows of the indexes. Some names will break out, it'll start popping through these pullback buys. And I call them the last of the Mohegans. They're the ones that held up. Then they get to them. Then they suck you in. You buy those, and they stop you out. They come in hard. I just to grab a few names, and I'm going to be in smaller positions anyway. It's not going to really mean much. It's just not really productive for me. So I'd rather just watch at this point.
Okay. Question from Torsten asking, I have a question related to the indexes like the S&P 500 and their potential influence on breakouts. From his observation, when an index breaks out of a consolidation, breakouts in stocks are more likely to work. Is that a true correlation you have found?
It is, but not in an exact way that you would ever want to. You would never want to make a qualifier that the indexes have to be breaking out for a base before you're going to buy stocks. That's a recipe for miserable results, because you're counting on a random index, and you're trying to get alpha, and alpha means that the stocks are going to do something different than the index. Matter of fact, alpha is calculated as a percentage gain above the S&P 500. So those stocks are usually going to set up coming off the lows. Even though they'll even set up and sometimes break out while the market indexes are in a correction or in a bear market, and you're rallying, and then the market goes to a lower low and the stock just pulls back to its breakout. So the leading stocks and the best stocks will decouple from the indexes. Now, yes, great. If you got the wind in your sails and the market's rip roaring, it's going to lift most boats. But that's not the way you want to trade. That's not the way that I trade. That's not the way Mark Ritchie trades. That's not the way David Ryan trades. That's not the way Bill O'Neill trades or traded. And Bill O'Neill, of course, has a whole section in his book about market direction and follow through days. People misinterpret that and think that Bill is only going to buy if there's a follow through day, and that he's not looking at the leading stocks until the market's in gear. No way. Bill's looking at the leaders and keying in on those, and of course going to get more aggressive once he starts seeing all the pieces of the puzzle come together. But that doesn't mean that back in 1990. There was many stocks breaking into new high ground before the market even made a low. And many of these bear markets, almost every one of these bear markets. Well, that's another thing. I was just doing some examples or setting up some examples for the Master Trader program last night. DocuSign was one that was coming as the market was coming off the lows, breaking into new high ground first.
And then
So my answer is that's not a strategy you want to. That's not what you want to do as far as when you're trading stocks and for trading growth stocks.
And he continues with the converse. If the indexes are recently extended, he would be looking to avoid breakouts due to the anticipation of an index correction.
No, it's a very bad idea.
Pulling the stocks
down.
Look,
I'm going to give you a piece of advice. Get the indexes off your damn screen and don't ever look at them again. And I know 99% of you are not going to listen to me and take that advice, but that would be the best thing you could do. You want to be a great stock trader? Take the indexes off the screen, shut the TV off, don't look at the news, and don't look at indexes, and trade just stocks. When the stock's set up, buy pilot positions. If they're working, add to them. And if you did that for a few years, and then you went back and overlaid your exposure over the market, you'd be amazed. You'd be 10 times better at calling market turns by default than if you tried to call market turns or if you let the market dictate. Once you start looking at the indexes and the random parts of the market, the most random areas of the market become your lead. It's illogical. It doesn't make any sense. You're trying to beat the market. You're trying to beat the S&P 500, and now you're going to use the S&P 500 as your guide. You're actually the tail of the thing you're trying to beat. The head being of the snake, being the market in the indexes, and now you're going to be a caboose to the thing you're trying to beat. How could you ever beat the S&P 500 if the S&P 500 is leading you? It doesn't even make sense. So it's just completely, in 40 years of doing this, that literally that is the number one thing that made me become a great trader, was to completely get away from that. That was the thing that had me not beating the market. Was when I first started, I formed an opinion on the market, then I looked for the groups, and then I looked for the stocks in the groups. I was never in the leaders. For 6 years, I couldn't understand how I was always missing the leaders. And I'd go back and go, oh my God, that stock set up perfect. Why didn't I buy it? Because I was biased from waiting for the damn market, quote unquote, the market. Meanwhile, all the leaders were breaking out of bases. So then I said, you know what? Forget the market. I'm just going to buy the stocks when they break out. I'm not going to get heavy unless it's working. And I'm going to put my toe in the water, and I'm going to grab these stocks as they're breaking out, coming off the lows. And then if I get a follow through day, I'll get more aggressive. And then everything turned around. Everything turned around. I made more money in a month than I dreamed of making in a year. So, and that's when it all turned around. Anyway, with that, I think we got to wrap it up. So we're getting about an hour and.
Yeah, just a question on FUTU. If the sell-off from the year or 2 years ago actually is still considered overhead supply, and being the stock is still down 90%.
Well, yeah, you do. You've got a big decline here. You've got this run up here, so you've got some overhead supply over on this side here. You don't have it in an uptrend yet, too. You see how you don't have much of an uptrend? So there's really no momentum here. There's no upside. There's nothing showing you that institutions are getting into this name. And yes, you do have overhead. It is a ways back, but it's heavy amount of overhead. So you got to be cognizant of that. And you still have overhead right to the left here. Look at this decline right here. So see, it already came back and it rallied back into this supply. And then look what happened. It got crushed. This is perfect, classic action. And now you're rallying right back to that supply where it got crushed from there. So this is one that you're really gambling, trading stocks like this. You want stocks that are in uptrends, nice, strong uptrends already, not much overhead supply, or the supply is way back. And while some of these may work, you got to think probability. You put this on a bell curve, these plays are not going to work nearly as well as the stocks that are in good uptrends. Now, something like maybe an OLLI. This has some overhead too. Got a little bit of an uptrend forming here. Still not, not great though. You still got a lot of overhead, but this is a little bit, a little bit better action here. But if you look at the names that, most of them here, and again, something like this OLED, I struggled even putting this on because it's similar, but you got a little more of an uptrend at least. At least we're in a new uptrend here, and you do have some supply to deal with, but this is more tradable. It's tightening up over here. So when we get where we've got this big overhead and we're in a new uptrend, sometimes you'll see me put them on and go, well, why is he putting them on? There's all this supply. Because you're in an uptrend, you're coming out of a solid base. You've got a nice, this nice gap here that you got some demand coming off the lows here. Those are tradable. You might get a nice little 20, 30% move up. It comes in this supply, but that's enough for you to accomplish your goal with swing trading.
And I think one final question to comment, really, to make, guys, I see a lot of ticker symbols being dropped here. Remember, we do have the symbol Dropbox feature on the platform, and a lot of the names that you're dropping, I'm looking at quickly, is just not meeting the criteria for focus list. So drop them on the platform for Mark to be able to see them, just in case he is missing one. But a lot of what you're asking about is not on focus list for a reason, and that's really where you want to be learning from that. These short bases, I see a lot being suggested as well.
Yeah, and I'll caveat that with I have to admit that this weekend I did not get a chance to look at the Dropbox, unfortunately. So if your stock's not on focus list, it doesn't mean that I didn't like it. It means I didn't see it this weekend. So I gotta fess up there. Let me see. ACIC. So here's a stock, low priced. We put it on, it was already extended up by 7 or 8%. Now it's up 17%. So, some stocks will work, in this type of market, and you'll get these moves. But see, this has got some momentum. At least this has momentum, and you get a chance, to catch, to catch a wave here. But anyway, with that said, I got to run. Yep.
We'll wrap up with that. And with that said, look for the replay to be available here momentarily. And we'll look at the Brandon and Mark Ritchie question and answer session this week, which we'll post, and also with staying tuned to the live stream for real-time alerts right through the remainder of the week. And we'll, with any other questions that were not answered, please try to say them and then just drop them in for next time. We'll get through with them.
Monitor the platform throughout the week. Are probably going to be light on action here, but if key things happen, I'll comment on them. So this is a very important time to watch carefully now over the next several days and this whole week here, see how things transpire. Okay.
All right, guys. Thanks, Mark and Mark.
See you guys. Bye-bye.
Bye.
Take care, guys.